Good morning from London. I'm Anna Edwards alongside Guy Johnson and Chrissy Gupta. We're an hour away from the opening trade. Here's what you need to know. President Trump says he plans to use the shutdown to fire federal workers. Meanwhile, the Fed's Austin Goolsbee warns the delay to data will make it harder for rate setters to interpret the economy. The EU presses ahead with plans to unlock 140 billion euros from frozen Russian assets to help support Ukraine. This as G7 nations look to ramp up sanctions on Moscow. Plus, an OpenAI share sale values the company at $500 billion, making it the world's largest startup.
In the meantime, a quick check on these markets. Remember, we are on day 2 of a U.S. government shutdown. That might explain maybe slight underperformance you're seeing in U.S. futures relative to the outperformance of Euro Stock 50. Nevertheless, both indexes at the moment in the green, higher by about 0.6% on this side of the Atlantic. 410 on the U.S. 10-year. Of course, one eye firmly on the inflation story, the tariff story, and, of course, what the labor market indicates. 410, the bottom of the range that we've been seeing bonds trade in. How does that show up in the FX market? Perhaps a dislocation there. 117 on euro dollar. The countdown to the opening trade starts right now.
Thursday the 2nd, good morning. Two things continue to drive these markets. The AI trade, we'll talk about what is happening with OpenAI in just a moment. There is a whole range of news out this morning. It remains a confusing picture, but the market continues to push asset prices higher. Look at China today. The HSI, absolutely fascinating in terms of the share price performance you are seeing there. The other is what is happening with the US labour market, which is really confusing right now. We don't have any official data. We're relying on the ADP and the ISM and other survey data that we are watching. We're waiting to find out whether the Trump administration is about to fire a whole load of federal workers. There's a lot of uncertainty, but the shutdown is making that uncertainty a lot greater, and we don't know yet what is happening. Are we going to get a picture anytime soon? It's really interesting. The sense seems to be no.
There seems to be no. Valerie Titel, our markets correspondent, raised the issue earlier this morning. She said that we're getting ADP numbers, yes, but we're also getting some state jobs numbers here and there. Yep. So if you're if you're feeling really motivated and you want to count that up and tally it up and bring some sort of number, power to you. But to your point, it is a confusing picture for the labor market. You mentioned the firings or potential firings that we might see from the White House. There's plenty of funding freezes that you were seeing when it comes to state aid, when it comes to some of the federal agencies as well. There is a thought in these markets that ultimately this shutdown is like every other shutdown and that there will be some sort of agreement. It may not last that long. These negotiations are happening behind the scenes. I'm not so sure. Dare I say this time feels different?
Well, this is an opportunity, and we heard this actually from Republicans yesterday, that there is an opportunity in this for the Republican Party to fire people that they don't want in post. Now, that might be later legally challenged, but in the meantime, maybe it affects the data and it creates a whole lot of noise around this story.
So would that be good news? So for the financial market point of view, is that good news? Because at the moment, it looks like bad news is good news. Labour market weakens, financial assets go up, the stock market goes up because there's an expectation that the Fed is going to be able to cut rates, because you're in this sweet spot where it doesn't cause a recession but does allow the Fed to cut rates.
But even if you think that the Fed might be, not the Fed, sorry, but federal workers might be overstaffed and you think maybe there is room for cuts, any eating into the rule of law and a sense that this is not done in a way that is in accordance with that could create some nervousness.
I wonder whether
in the way it does with the Fed
secondary, but that feels like a secondary consideration in as much as you get a short-term labour market shock, you get a consumption shock, you get this would be a demand shock for the US economy in theory if you were to see all these workers being fired. Sure, there's going to be a long-term benefit and there'll be a rule of law question, the long-term benefit being in terms of the deficit. But in the short term, that's a shock. Now, how does the market react to that shock?
More cuts.
Is it precisely? Yeah. And is that good news? And when do we get to the bad news bit?
Well, the counter-argument is that the federal workforce doesn't make up the bulk of the labor market in the U.S., so there is a competing argument that says that long-term benefit may be seen even earlier if the idea here is that ultimately the moves that you see in the federal workforce don't actually impact or aren't indicative of what you're seeing in the broader labor story. So that's just one argument. But of course, this is going to be something that is very worrying because at the end of the day, there is still funding, there is still data, there are still lapses that we see. And this could actually accelerate some of the plans that the White House has had that may have taken years.
Well, that's what I mean.
Into the span of weeks.
Everything becomes very. This could happen very quickly. And as a result of which, if you have just lost your job, do you go out and spend money? Do you go out and buy a new car? Do you buy a new washing machine? Do you do all the things that you would normally do as a consumer?
Yeah.
Don't know.
How much weaker? Yeah, how much weaker is the administration willing to make the US economy to prompt more rate cuts? I suppose is also part of the dynamic we're thinking about here. Should we go on to talk about Ukraine and some of the news flow we've had coming out of Denmark, but also coming out of a G7 finance ministers meeting? So we stick with what came out of Denmark first. This is interesting in the progress that the Europeans are making when it comes to using the profits and to some degree the principle of the frozen assets, the Russian frozen assets, and putting those to work in the interests of Ukraine. So that's part of the deal, and Russia is threatening some retaliation if that happens. The other thing that really caught my eye was this G7 agreement, because of course the G7 includes the United States, and the fact that they do seem to be very much on the same page on some of it, at least on the need to increase sanctions, including perhaps sanctioning Russian oil majors, targeting the shadow fleet. So the cracks in the sanctions envelope against Russia that have existed, or the holes in it that have existed, maybe there's a sense they get filled, but just at the margin, do you get a sense that perhaps Russia, US thinking on Russia is evolving in some quarters?
We're going to talk to the commodity story a little bit later on the programme. I think this is really interesting. If the story that really stood out to me this morning was the one that America may allow long-range missiles to be used.
Add the journal, yeah.
And I think that is hugely significant, and I think it has big implications for the commodity market. Ukraine has been targeting Russian refineries and oil infrastructure and gas infrastructure. If you were able to do that and target further into Russia, do you start hitting even bigger sites and more important sites and really diminish the capacity? Russia remains a big exporter of energy and of hydrocarbons around the world. If you could reduce that, what impact will that have? Now, this is a market that is already oversupplied, but do you just eat into that oversupply that we are seeing? And
perhaps that read-through is something that's going to be reflected in the defense story at the Open today. There's another piece of this, which is to your point of the sentiment shift that we're seeing in Washington. Secondary sanctions haven't been talked about in a long time. I say a long time, it's really been like a week. But in Washington politics, a week is a long time. The idea of targeting the Russian kind of money machine via tariffs on India, via tariffs on China, that sentiment seems to have abated, whereas that will come up in the summit today. Yes,
it's something that President Trump has pushed very strongly. It is something that's mentioned in that G7 communique, but it basically says that all nations commit to seriously consider putting secondary sanctions, or they don't call them that, but something that amounts to that on other countries. You wonder if that's a holding pattern.
Probably. Almost certainly. I don't know if we've buried the lead this morning. OpenAI is worth $500 billion. We've had a share sale by internals, and that values the company at that huge number, $500 billion. There's so much going on around this story at the moment. You've got a huge rally that is taking place in Asia. Look at what has happened today in Hong Kong. Look at Baba shares. Everything is screaming higher at a rapid rate. We've seen Korean stocks. You've seen ST Hynix and Samsung rallying as well on the fact that they are going to be supplying the Stargate project with kit as well. Just so much going on here, and this thing is rapidly accelerating to the upside in terms of the valuation that is being attached to it. A couple of things really stand out to me, though. One of which is, it was pointed out to a Bain guy that I was talking to a couple of days back, who was saying, look at what is happening in terms of the transactions within the OpenAI ecosystem. The Journal, again, had this story a little earlier on this week. OpenAI is now starting to allow transactions. There's this big concern around, you have this huge valuation, but you don't have any revenues. When do the revenues come? And if you start to allow transactions within the system, that is one way that you could maybe generate the revenues that are going to be created here. So I think that's a really pivotal piece this week. The other one is that there's a video sharing app that is now being produced as well. It seems like they're creeping into other areas of other people's businesses, which I think is going to get really interesting. The competitive threat is going to be there. And they're now starting to generate a valuation which puts them on quite interesting levels versus, say, SpaceX.
Yes, bigger than.
Like big businesses, private businesses, I know, but big businesses.
And it's interesting as well that of all of the staff who were given the opportunity to sell at this point, they didn't all take up this opportunity. No. So, they could have made a lot of money out of this, but they think they'll make more if they wait, which gives, if you like watching signals from insiders, then there's one.
We definitely like that. I did a quick search on our handy-dandy Bloomberg terminal of the biggest stocks in the S&P 500, just to understand where what $500 billion actually means. The closest we get is the Netflix market cap, which is about $509 billion. So OpenAI is roughly valued at the same size as Netflix, which is a top 30 company in the S&P 500. I thought that was really interesting context to the point. without revenues, without the monetization piece. But it's still a non-profit.
Yeah, precisely. So much still to do in terms of the structure of the business, so much still to do in terms of understanding what the revenue model is going to look like. And I think subscriptions are going to cut it in terms of generating the kind of revenue they're going to need to back up the kind of infrastructure spending they're delivering at the moment. If they can find other ways of doing it, like video is clearly a key area of interest, and Instagram is a very kind of important and big business, I'm told.
Maybe you'll get one this time.
Maybe. And
he's there if you look hard enough.
You really got to look hard. But this transaction story, I think, is fantastic. It's to do with Etsy. If you can deliver transactions within the OpenAI infrastructure, you start clipping kind of a little bit off every one of those transactions. That's when you could start to see serious money. So is OpenAI about to just become an e-commerce site? Does it become your personal shopper? I'm told those are quite good as well.
Quite handy. Let's talk about shopping, Guy. We have numbers out from Tesco. Thank you very much for setting that one up. Tesco, a big grocer in the UK, of course, raising its profit forecast for the fiscal year. It's apparently won over more shoppers than expected with its competitive pricing and range of products. The upgrade to operating profit guidance is not huge, so, I'll keep that in mind. But it has upgraded. It has raised its full year.
It looks like they're going to get a bit of a kicker from the government as well. Looks like the higher rate story is not going to be applying to grocery stores. That's the story that I think the FT is running with this morning, and saying that actually, so there could be a tax story as well that could benefit the business this morning when the shares open.
Yes, I wonder, talking of politics and the way it fits with grocery stores, they can get meshed together in a way that Tesco wouldn't like, can't they?
No,
I mean, there's a lot of
inflation
in food prices right now, and if that's at all attached to the performance we're seeing here, that'll get the attention of Westminster.
Certainly will. Let's talk about what we've got coming up on the show. We need to talk about the fixed income story in a little bit more detail. Laureline Renaud-Chatelain, Senior Fixed Income Strategist at Pictet Wealth, is going to be joining us. I've got so many questions for Francisco Blanche this morning. I'm not sure we're going to have time. He is the Head of Commodities and Derivatives at Bank of America Global Research. Remy Olupitan, Head of Multi-Asset Growth at Schroders, is going to be joining us as well. And Saima Hussain, Equity Research Analyst at Alphavalue, is going to be joining us a little bit later on. We're going to talk tech. We've got so much to talk about on the tech front as well this morning. It's a fixed income story. It's a AI story this morning. But there's also a data story. We have data here in the Eurozone, Chrissy.
Yeah, we do. And you should mention the defense story, very much a key part of all the conversations across the board this morning, including the one with Alphavalue as well. Let's talk about the data. To your point, 10 a.m. UK time, Euro area unemployment is going to be hitting the wire. But the focus here is, we're day 2 of a shutdown. How does that impact the data that we're seeing? Well, it's likely to delay some of the U.S. jobless numbers, the factory orders. I'm going to repeat what Valerie told me this morning, which is simply we are getting some state data kind of hitting the wires across the board for the folks who want to collate that. Some commentary out of the Federal Reserve as well. Fed's Logan is going to be speaking at 30 p.m. And then comments from the ECB as well. Villeroy and DeGuindos speaking from 5:30 p.m. UK time onwards, plus some Tesla sales at 9 p.m.
OK, let's talk about what else we need to know this morning. Arab and Muslim national leaders are pushing Hamas to accept the Gaza plan unveiled by President Trump, saying they need to end the fighting surpasses concerns about the finer details of the deal. Separately, the Israeli military has intercepted boats carrying humanitarian aid to Gaza and detained activists, including Greta Thunberg. It is being reported the UK is weighing a plan to exempt shares of recently floated companies from trading taxes. The Financial Times is reporting the relief could last up to 3 years and may be announced in Chancellor Rachel Reeves' budget next month. French unions are holding a new round of anti-austerity protests today, seeking to maintain pressure on Prime Minister Sébastien Lecornu and his expected budget proposals. Walkouts are planned in sectors including education, transport. Air traffic disruptions should remain limited, with only Paris Bouvas Airport expected to reduce flight schedules. High-speed trains and the Paris Metro should be running normally. This kind of takes me to Italy, actually. The compare and contrast between France and Italy, I think, is really interesting at the moment. You're going to have a budget, I think, approved a little bit later on by Cabinet in Rome. And it's likely to see the Italian deficit down to 3%, which is going to remove it from the procedures that are being the excessive deficit procedure out of Brussels, and could allow more defence spending. But just to compare and contrast between Italy and France at the moment is stark.
We saw rating agencies moving things in that same direction, that contrasting direction, upgrading Italy, of course, and going as far as upgrading some of the Italian banks yesterday, I noticed. But I think the link with the defence theme is really important, isn't it? Because this is a country that's made Giorgia Meloni has made a lot of her relationship with President Trump. She's promised a lot when it comes to defence spending, and there needs to be space in the budget to deliver that.
Absolutely. Italy's kind of putting everyone to shame in Europe right now. It feels like, with the credit ratings changes, with the budget draft as well, because there was a narrative, I want to say last year, where, and it showed up in Spain as well, that if you don't actually hit the budget cap, then maybe it leads that, well, if Italy doesn't match it, then maybe Spain doesn't have to match it and Greece doesn't have to match it, et cetera. Now that Italy's actually following the rules, everyone else kind of has to as well, in theory.
There we go.
Italy is following the rules.
There we go. 7:15 here in London. Coming up, let me tell you what's coming up on the programme. Siemens is said to sell off part of its big stake in the medical equipment company Siemens Healthineers. We'll check on the stocks of both of those German companies at the open. Plus, as OPEC explores resuming production increases, some analysts warn of oversupply risks. We will talk oil, as Guy said. Francisco Blanch will be with us. Up next, Fed rate setters are concerned that data delays will impact their ability to read the economy. Will they get enough from the private data, from the ADP, from the JOLTS numbers, from the ISM that we've had so far? If you want to join that conversation or any other around this desk, IB plus BPTV Go. That is the function on the Bloomberg terminal. This is Bloomberg. Welcome back to the opening trade. Now, the Chicago Fed President Austin Goolsbee says the delay of data will make the Fed's job of interpreting the economy more difficult. So the delay to that data, obviously an issue for markets. Valerie Teitel has been thinking deeply about this.
Well, maybe the broad thought is that government shutdowns are bullish for global stocks. It's definitely what we saw in the session yesterday. Not just U.S. indices notching record highs, also one here in Europe, FTSE 100, Euro Stoxx 50, and then out in Asia, MSCI Asia Pacific also notching a new record overnight. All this enthusiasm for risk at the moment has really been pinned down to that weak ADP print yesterday. Yes, we're not going to get jobless claims today. Yes, we're very unlikely to get that NFP on Friday. But the weak ADP yesterday was really enough to cement the fact that the Fed will cut in October in the absence of data, and is looking like we'll cut again in December before the year is out. It did lead to quite a substantial rally in the front end yesterday. Those two-year yields dropped around 7 basis points in the session. It was the biggest rally for the front end since the last NFP report. So it's been about a month that we've seen such a brutal price action in the front end. But that ADP report, Guy, did really show quite a breadth of weakening labor market data. 70% of industries surveyed by ADP did show negative hiring in the previous month. So perhaps maybe we're not going to get the NFP, but it does seem like the ADP did confirm that the labor market, at least, is on a weakening trend.
It's interesting, you compare and contrast with the last claims number, which looked all right. So we'll wait and see what the full gamut of data looks like, or will we? Because we don't know where we're going to get it. And will the Fed have it by the next meeting? Laureline Renaud-Chatelain, Senior Fixed Income Strategist at Pictet Wealth Management, joins us now. How difficult is it making your job that we don't have US data right now?
Very difficult, but I think for the Fed as well. I mean, being like this in the dark about the state of the labor market at that moment when it's so crucial to know if the economy is still adding jobs. What we've seen so far is definitely it's harder to get a job once you're laid off, but we're not seeing, as you mentioned on jobless claims, higher layoffs. So for now, it seems to be a very fragile state, and I think Chair Powell also said he's concerned about this fragile state. So I think for them, it's very important to get the...
Valerie said that the ADP data yesterday concreted the possibility of a rate cut at the next meeting. Do you agree with that?
I think anyway, they were going for probably another rate cut even before we get the ADP. I think in this context, what we know is the ADP is less reliable than the non-farm payroll. But we've seen also over the summer is this strong revision downward of the labor market employment. And as such, I think it put anyway the Fed in a position where they are coming for 1 or 2 rate cuts for this year at least. And then maybe they will pause and think for the next year.
Is this bond market underestimating the potential re-acceleration of inflation, not just from tariffs, but from healthcare costs come January 1st?
No. So I think that's a good question. When you look at the market pricing, looking at inflation swap, for example, on the 1 year, we're already at 3.3%. So I think the market has thought, okay, healthcare tariff is going to push up inflation. But then on the other side, you have maybe downward pressure from energy costs going down. Also, you have this downward pressure from services inflation, which is like moderating quite a bit. So all in all, I think the market is getting ready for higher inflation, but not in a sustainable way. I think when you look at the long-term inflation expectation, they remain very well anchored, with the 5-year inflation swap close to 2.5, break-even close to 2.4.
I'm looking at 410 on the 10-year yields, kind of bouncing at the bottom of its latest trading range. How low do yields go?
So at this stage, our scenario is that we don't cross 4% unless we get a really much weaker labor market with negative non-farm payroll prints. I think when you get to negative non-farm payroll, there is no more discussion about this equilibrium that is maybe lower because of less immigration. It's really like the market shedding off jobs, and then obviously that makes us more concerned, and that could open the door for the Fed to actually cut much more aggressively and below 3% terminal rate, which is what the market is currently pricing.
Yeah, I wonder how you say negative non-farm payroll, or no non-farm payroll print. I mean, we'll see how negatively that is interpreted or not. What about Fed independence, Laureline? How do we need to factor that in right now? We saw the news around Lisa Cook yesterday. She stays for now. The White House fights on, says they're going to win in January. We'll wait and see. What does this told us? Has this told us that there is more Fed independence than perhaps some people were concerned about? What's your conclusion?
So I think it was a very good signal regarding the statute of the Fed as an independent central bank, I would say. Now it does still put into question if Cook will still be there in February when the Fed governors have to elect the new regional Fed presidents. And that's the real key question, because if we don't have Cook by the time, it means that you have a majority of Fed governors that have been appointed by Trump, and these one could decide to elect Fed regional president that are obviously more leaning towards Trump, and then you have a majority of the FOMC who would be leaning towards Trump.
Can I pivot us to European government bond markets? And I know that you actually favour those over treasuries. So let me ask you about Italy. Briefly, Laureline, what lessons should other indebted nations take from what Italy has been doing? At least the momentum has been moving in the right direction there.
Yeah, I think what's really key, and you mentioned it, so first, putting your fiscal house in order with deficit going down. Debt to GDP is obviously going on also mechanically because inflation was rather high after COVID. And then political stability. I mean, what's very important is that Meloni has been really empowered, I think, by the political establishment and the people of Italy. And so that's why she's now putting in place some reforms that I think French government has difficulties to pass.
Very quickly, 30 seconds. Is there a risk here that because people may be pulling away from sovereign debt, they're piling into corporate credit? Are you seeing that fund flow show up?
So I don't know if we see this fund flow, but there is this old debate about having tight IG credit spread and all this discussion about very high quality credit, indeed replacing in a way sovereign bonds because you have more concern on the fiscal sustainability of sovereign bonds than maybe very highly rated corporates.
That sounds like indigestion on its way, maybe in 2026. Laureline Renaud-Chatelain, Senior Fixed Income Strategist over at Pictet Wealth Management, joining us around the table. Talk a little bit about the bond markets on both sides of the world. Coming up on the program, we're going to talk about European leaders and their meeting in Copenhagen today. I'm going to say my words right, to discuss the region's defense strategy. Lots of conversations happening. There's also a question in the States of whether or not you've seen a sentiment shift when it comes to the White House and their approach to Vladimir Putin and, of course, the defense strategy over in Ukraine as well. That's the conversation we're going to have with Oliver Crook shortly, and, of course, a defense analyst throughout the program. Stick with us. This is Bloomberg.
Welcome back. This is the opening trade, Thursday, the 2nd of October, 7:30 in London. And the futures picture then for European stocks looks broadly positive. We had some positivity late in the day stateside as weaker data, it made traders think more about rate cuts, and that helped push things a little bit higher. So European stocks expected to go a little bit higher this morning. US futures look flatter. E-minis up 0.1%, Chrissy.
In the meantime, a quick check on these bond markets. We've got one eye firmly on France, one eye firmly on Italy as well. And yet, the bond market does very little to our shock and awe. U.S. 10-year, though, at 4.10. I wonder if some of that shakes out further throughout the session, Guy.
We talked about inflation a little bit earlier on. There isn't much of it in Switzerland. I'm just seeing a little bit of a spike higher in Euro Swissy right now, which I'm just keeping my eye on just to kind of see what's going on here. The Swiss CPI data, remember that the Swiss are trying to basically hold rates where they are at the moment in terms of what the S&P is doing. So the CPI year-on-year comes through at 0.2, which is a little softer than the survey number of 0.3, but kind of in line with what we saw last time around as well. The month-on-month number dips negative 0.2, and the harmonized CPI EU number effectively dips negative 0.3. So what you've got here is a headline number that looks fairly weak. If you break it down there and you go below the surface and look at the core number, it's still at 0.7. And I just wonder whether that kind of core year-on-year number is going to be enough to keep basically the S&P where it is right now. The Swissy is weakening on the back of this number. So maybe actually that's not the read, and maybe actually the read is that actually we do have a disinflation problem in Switzerland. That certainly would be maybe the reaction I'm seeing in the currency markets.
Does that mean chocolate gets cheaper? That's really all I care about. Okay.
Coffee, chocolate, kind of, yeah.
Fair enough. Let's talk about another major subject when it comes to what's going on here in Europe. European leaders meeting in Copenhagen to discuss how to focus the continent's defenses and reinforce support for Ukraine. Leaders pressing ahead with a plan to provide 140 billion euros in loans from immobilized Russian central bank assets. Our European correspondent Oliver Crook joins us now from Copenhagen. Ollie, just walk us through what we can expect when it comes to this meeting.
Yeah, so today will be the meeting of the European political community, which is this large format that's sort of been devised by Emmanuel Macron. It's been going on since the invasion of Ukraine. And this is the sort of community meeting that brings together not just the EU, but also sort of Turkey, Norway, the UK, all of these other countries in order to discuss issues, primarily defense. That was sort of the function of the meeting. But really the action was yesterday at the EU Informal Leaders Summit that is basically paving the way for this next summit, the formal summit in about 2 weeks' time, where they hope to actually ratify and make major step forward on that main issue that you just discussed there, which is the immobilized Russian assets, the 140 billion euros worth of them that are sitting in Belgium right now, and basically trying to figure out what to do with them, how to monetize the principal that they've been sitting on for all of these years. They've come under great pressure from several U.S. administrations, including the Biden administration, and basically the Europeans said that there was no legal way to touch those assets. Now that the checks have stopped coming from the Trump administration and there's this fiscal strain across the European continent, they are getting serious about finding ways to basically circumvent dealing with this, taking those assets without sort of stealing them. And the format that would take is a front-loaded loan of about 140 billion euros that's paid out over a period of time, that's backed by European member states. And basically the Russians would have to pay reparations to Ukraine in the future, and only then would Ukraine have to pay back the loan. And otherwise they would be backed by those Russian assets. As you can tell from what I'm talking about here, this is a very complicated process, and one that they still need to figure out and to fine-tune. But the sort of headline here, and this is now a plan that is backed by Chancellor Merz, something that the Germans were reticent to back for the last couple of years, is that they need to prove to Vladimir Putin that not only are they supporting Ukraine, but that Ukraine's war efforts and its military are funded not just for this year, not just for next year, but for the indefinite future in order to bring Putin to the negotiating table.
OK, let's factor in another element to this story. The G7 now looking at Russian oil sanctions in a slightly different way. What's the latest? Where do we stand?
So what's interesting is now you had the meeting of finance ministers of the G7. They put out a statement yesterday to sort of look at ways in which they can continue to put pressure on the Russian oil and war machine, and basically looking at, yes, expanding them to the sort of shadow fleet, looking at sort of refining capacity, all of those sorts of things. But what they're starting to talk about and what they're starting to look at more seriously is this proposal that was floated originally by the Trump administration, which is secondary sanctions. Now, that could take a lot of different roles. What Trump has talked about in the past is basically slapping 100% to 200% 100% sanctions on China and India because they're buying Russian crude oil, that is unlikely to be kind of the route that the G7 take, but they will be looking at potentially sanctioning companies and sort of Chinese companies that are involved in refining and those sorts of things. And that would be something that would put significant pressure on Russia in a way that they haven't really looked at doing before. And that would be sort of a significant step forward. Now, the question is, at what point do they get there? Will the Europeans sort of sign up for this? Remember, Trump had said at one point that basically the U.S. would follow the EU if they put 100% tariffs on China, and the EU would have to go first, and then the U.S. would do that. That is something that is unlikely for the Europeans to sign up to. But what they're looking at now is trying to wage this maximum pressure campaign and trying to find new ways to sanction the Russian crude oil, which is, of course, the lifeblood of the war machine within Russia.
Ollie, thanks very much. Oliver Crook live for us in Copenhagen and throughout the day with that wider European group meeting. Let's focus in on the energy elements of what Ollie was talking about there. Francisco Blanch joins us, Head of Commodities and Derivatives at Bank of America Global Research. Francisco, nice to see you, and so much to talk about. We'll talk about the potential for too much supply in the markets and all of that. But can I focus in on the Russian flows first off and what we might see, what might the effect be of some of these G7 measures? Because up to this point, the G7 and others have been trying to place sanctions on Russian energy that don't push up energy prices too much for everybody else. Is that still going to be what we see here? How is this going to play out?
Well, remember, part of the reason why the market hasn't reacted that much to this news is because we have OPEC, the group of 8, continuing to add barrels. In the last 6 months, we've had meeting upon meeting where OPEC has announced capacity increases, bringing those spare barrels back into the market. So, and more recently, just a month ago, we had another 1.6 million barrels a day of incremental capacity. So that's kept the market quiet. But again, it's not just sanctions. There's also been Ukrainians have started attacking Russian energy infrastructure more directly, which they weren't doing last year. And yet here we are with Brent at $65 a barrel. I think what's been really interesting is despite the apparent surplus, right, which is visible in inventories, we haven't seen prices crashing. And part of it is that China's accumulating an enormous amount of this oil back in strategic storage. So that's ultimately what's going on. There's a surplus going to China, and then at the margin, Europe, the US are biting, and Ukraine are biting at Russian energy revenues.
Yes. We have seen Ukraine, as you say, target some areas of Russian infrastructure already. There must be opportunity to target more, go further into Russia to target other kinds of energy infrastructure. How material could that be? And I mean, are we basically going to continue to get enough OPEC flow that this stops oil going higher?
I think for the time being, the answer is yes. Remember, I think OPEC Plus is very committed to price stability right now, and frankly, recovering market share. I've been saying this for a while here is going to be kind of a long and shallow price war. They want to get their market share back. They've lost a lot of market share in the last 4 or 5 years. So I think the answer is yes. But remember, what we're starting to see already in the oil market is that spare capacity is running thinner and thinner every time OPEC makes a decision to bring capacity back. So at some point, and you're starting to see in the long end of the oil curve, things are starting to pick up, right?
Can I just come back to this issue of Russia and the facilities it has? There's a story, I think the Journal has it this morning, talking about the idea that the US may provide longer-range missiles and intelligence to back those missiles up that could allow Ukraine to strike even more infrastructure in Russia. Is that a product market story? How much has already been degraded? How much more could be degraded if you were to be able to strike further into the continent?
So for the time being, Guy, you're right. There's been a product story. It's been diesel primarily and gasoline that have been impacted. We've seen refining margins picking up. And within Russia, there's stories around fuel shortages. But crude exports have been less impacted. Now, we've seen attacks in Primorsk, in Lostuga. So some of the Baltic export capacity has been somewhat tainted. But pipelines can be repaired relatively quickly. So, and yet again, I mean, there could be a lot more. I think there's a lot more you could do. The question is, what's going to be Russia's response if Ukraine goes much farther with this campaign, right?
Okay. Let me turn to another subject that I'm fascinated with this morning, and that is what is happening. Everything's an AI trade, right? It feels like it is at the moment. sitting in the chair yesterday, Brookfield talking about the idea that electricity is the biggest bottleneck currently, electrons. We don't have enough of them to feed the AI beast that we are building. From your point of view, what is the correct way of playing it? Is it buying uranium companies? Is it buying builders of gas turbines? How do I play the absence of electricity to feed the AI story? What's the best way of doing it?
So if you think about, I mean, you're right, we have an electron shortage, and it's visible in the U.S.
Yeah.
If you think about different markets in the U.S., the ERCOT market in Texas has been growing very fast. We wrote a recent report on this. But Texas is pretty flexible, so there's a lot of growth there, and we're looking at electricity capacity growth of 3% plus per annum. The one market that has actually starting to look a little bit tighter is the U.S. Northeast, where there's not enough capacity to accommodate the wave of demand for electrons. And then the interesting play, to your question, is really in Europe, because in Europe we have so much spare capacity, because we destroyed enormous amounts of demand for the last 4 years because of the Russian-Ukraine crisis, because of the high prices we had.
Yep.
So here we have about 160 gigawatts of gas-fired generation capacity running at 23% utilization rates. So if you need electrons,
Europe is the place to go.
Europe's the place to go, as you get more gas from the US into the continent.
Okay, just a quick follow-up on that. I also heard the other day that China has a shortage of chips, but doesn't have a shortage of generation capacity. So is that an advantage for China at the moment, that it has the electrons as well, that it can use to drive its AI push?
It's an advantage, no question. I mean, China's got a huge investment in solar, in wind, in battery capacity. All of this is kind of really feeding straight into the Chinese power system. They've also increased their coal-fired generation pretty dramatically, right? I mean, coal production in China is up 30% in the last 4 years. So I do tend to believe that the one place that's got the most spare capacity, generation capacity, right?
Yep.
I mean, that is like, let's turn this on right now, even if it's $80, $100 a megawatt hour, is Europe. I mean, that's where you have the spare capacity. Again, because we've shut down aluminum smelting, we've shut down steel, steel making capacity, we've shut down cement, we've shut so many industries. And this would allow Europe to really bring up a lot of these electrons quickly. Now, of course, some of this may be gas-fired, so there's a carbon footprint associated to that. But I do think we have a lot more spare capacity in the continent. And you've seen that in Ireland. Ireland's recently signed off a deal to do gas-fired power to develop data centers. And so I think this is going to continue. I think the tech companies are going to look at Europe and say, yeah, okay, there's a lot of things that don't really work in Europe, but we can actually get electrons there in the next 6 months, which is not going to be available almost anywhere else.
Is there a line in the sand when it comes to the AI data build-out that in the U.S. that specifically pulls on these natural gas resources that ultimately means that some of the excess excess flows from the U.S. that are being exported to Europe right now aren't exported to Europe, that stay domestically used?
Well, so remember, the one thing that connects Europe to the U.S. Is the LNG flow, right?
Yeah.
On the power side. And the U.S. is ramping up liquid natural gas export capacity at a very fast pace, right? So we are going to see, and President Trump's made a deal with the Europeans to sell $250 billion every year, right? Yeah. And the U.S. doesn't even export that much, right? So U.S. is ramping up right now. All this is going to come to Europe. Europe has the power generation capacity to absorb all that gas. Now, there's a carbon footprint, there's a carbon cost, right? So, and I don't know what the politics are going to be around this. We've seen Chancellor Merz in Germany asking for a delay to the electric vehicle implementation rules and the phase out of diesel-fired vehicles and internal combustion engine vehicles. We are seeing some policy twist in the UK as well. But I do think the one place that's got this spare capacity is Europe. I don't think it's going to tighten the U.S. market that much. There's a lot of gas in the U.S. Every time prices go up, producers respond. The one thing that is going to tighten the market in the U.S., and it's already tightened the market, is actually the lack of capacity, generation capacity, that is. And in fact, if you look at inflation in America today, energy inflation is down year on year, but that's a big split because gasoline's down 8-9%, power's up 7%.
Electricity is, yeah.
So you have a massive, the minute that we see the bottoming out of that gasoline effect, right, that base effect, energy inflation is going to come back into the U.S. in a pretty good way. So maybe at that point, the U.S. government starts focusing on it. But again, it's going to have little to do with the ability of the U.S. to produce gas. It's got to do with the ability of the U.S. to produce power, if that makes sense, right?
Yeah. So less of constraints on that space, but connect that to the oil story then, because you know utilities in the States have a very unique ability to switch between oil and gas use.
Yeah.
So if oil is coming down further and further and further,
right,
does that then mean the utilities switch to oil, and is that where then you see the constraint?
You are 100% right. This is one of the concerns that I have, is one of the concerns that Middle Eastern producers have, is that with this low prices, right, there's a lot of oil demand that seems to be vanishing up in the air. We don't up in the air literally, and we don't really know where it's going, right? But oil is cheap, and remember, oil averaged $60 a barrel in 2009. Yeah. We are in 2025, okay? And again, it was the nominal average. If you adjust for inflation, oil's actually pretty cheap. It's way cheaper than it was in 2009. So even I think we averaged 60 around. I think it was in 2006 we averaged 60, right? So we have relatively low oil prices compared to history. And this even is true relative to gas. So a lot of this oil is being used across the economy, and it could tighten the oil market pretty quickly. Oil is about a third of the energy we consume. And even though it doesn't really play out that much into power generation, it could come back if prices stay this low. That's definitely an important point in a world where we are craving for electrons.
I said we had lots of questions. I've got another 10, but we're going to have to let you go. There, Francisco, great to see you. Thanks for stopping by to see us here in London. Francisco Blanche, Head of Commodities and Derivatives at Bank of America Global Research. Take a look at the gasoline price over in the United States. As we just said, it's kind of quite stable year on year. Do you start to see a bottoming out of that effect? Coming up next, we're going to talk about some of the stocks we're going to be watching into the open. Keep an eye on defence stocks. Keep an eye on the AI story. Keep an eye on Siemens, apparently exploring the sell-off of its majority stake in medical equipment maker Siemens Healthineers. We'll talk you through that. Tesco's on deck as well. UK retailers on deck. We'll talk about all of it next. This is Bloomberg.
Welcome back. It is 7:50 here in London. 10 minutes until we get to European equity trading. And this is the picture across European market futures. They are looking positive this morning. It seems that markets globally, in defiance of any kind of US shutdown wobble. Let us bring into the conversation Paul Dobson, our executive editor for Asia Markets. And the moves seem to have been quite positive through the Asia session, perhaps driven by some of the technology news as well. Record stock rally extending then, Paul. What's to worry about? Nothing, it appears.
Hi there. Good morning, Anna. Well, the biggest worry is, are we in a bubble? And if we are in a bubble, what do you do about it? How do you trade it? So far, it's still that kind of bullish momentum seeping through markets and playing out particularly strongly in Asia today. But lots of enthusiasm for deals involving OpenAI with Korean companies like SK Hynix and Samsung, which saw the Kospi take a really big leap forwards. OpenAI itself has been selling some shares, giving it a valuation of, what is it, $500 billion, something, unspeakably huge. If you're selling equity, you're in a brilliant place at the moment, and the market is continuing to embrace it. So I guess it is that concern. OK, so can we carry on going up every day exponentially like we are at the moment? Or is there going to be some point where that momentum starts to fade and we run out of gas? And if so, how much support is there when we get a dip? Will there continue to be buying? So far, that's been the case, whether it's in Europe, record highs, US, record highs, Asia, getting there as well today. But, kind of, can it sustain all the way through? I guess that's the thing that people are continually asking themselves as we continue to press higher.
How are we feeling about JGBs this morning, Paul?
I think we're feeling pretty nervous about government bonds in general, Guy. The Japanese had an auction today of 10-year debt. Didn't go completely swimmingly. There was a big tail, which means that although, there was plentiful demand for the bonds, it sort of tailed off. It fell off pretty quickly, meaning that people weren't necessarily prepared to match the bid price in huge volumes. And that's something that we've been seeing resonating across government bond markets. Think about, yesterday, I think it was, we had a German sale that went technically uncovered. In the UK last week, they didn't all look very pristine in terms of people showing up for government bonds. You can understand why when we're in this big bullish market for equities or one of the havens. Gold is also surging higher at the moment. Who wants those lower yielding government bonds? So today we've got auctions, I think, coming up for France, we've got Spain, we've got, the UK on the slate as well. So keep an eye on those demand metrics to see whether we get some more disturbing information coming through.
Does that all apply to U.S. Treasuries as well? Ultimately, is a government shutdown, a prolonged U.S. government shutdown, a positive or negative when it comes to Treasuries?
I think that is really the interesting point, Valerie. I've been puzzling over it myself. I think that, what we saw yesterday was a pretty good rally in US Treasuries. That was because the ADP numbers were surprisingly negative on the Labour front, so it makes people think that the Fed is going to be cutting interest rates again at the end of this month. That's positive for Treasuries, maybe, but it depends. The longer this shutdown goes on, the more it starts to kind of weigh on the economy, sort of like reduce that spending and dim people's sort of perception of the US as well. That could sour demand for Treasuries over time if it's not a circuit breaker to that shutdown.
All right, Paul Dobson, our executive editor for Asia Markets, thank you so much for your time this morning. He's making a crucial point, though. I mean, this could quite literally go anywhere. I think the markets, we talk about complacency when it comes to the tariff threat. Is this complacency when it comes to the shutdown threat? Or are we seeing a more pronounced reaction on places like gold?
The Fed narrative just seems to have dominated, doesn't it? And if shutdowns lean into that, because if they create economic weakness, get more Fed cuts.
I think the next 48 hours is going to be really interesting. Caroline Levitt was talking about job cuts are coming.
Yeah.
If that happens, then I think the narrative around the shutdown could change really quite quickly, and the market starts to really pay attention. If mass firings start to occur in the federal government, that's something you want to pay attention to.
And will there be feedback loops from either stocks or Treasuries back into the White House? We'll see. We will keep an eye on Nokia, Ericcson, Tesco, Bruno Cucinelli. All of those could be on the move this morning. European stock futures point higher. We'll be back with the market open in just a few minutes. This is Bloomberg.
Thursday morning, the 2nd of October. Let's talk about the 1st of October, to give you a bit of context as we think about how we're going to open this morning. This was the European trade. Europe had a really strong day yesterday. Records across the piece, stocks 50, FTSE 100, etc., etc. And we closed near session highs. The US market also pushed on, despite everything that is happening in the United States and shutdown fears. All of that didn't seem to matter for equities. The AI trade apparently is still on. We saw stocks rising quite sharply yesterday, and Korea looks like they're going to carry on this morning.
The party continues, and it feels like the party continues in Germany. So maybe there is that AI theme that we're going to see, maybe a rebound from yesterday's session to some of the weakness you saw or underperformance in some parts of the tech space. There's also a defense theme that's running through this morning. DAX futures, of course, the outperformers this morning higher by 0.5%, Anna.
Chrissy, let's talk about some of the individual stocks that are in focus, and we'll start with the grocery sector within the UK and Tesco specifically, lifting its outlook, gaining market share against rivals thanks to some of what it's been doing on pricing. Apparently that has been the key. We'll also keep an eye on Nokia and on Ericcson. So these key companies, of course, for Europe within the telecoms equipment landscape, and it seems that China is going to make it more difficult for those businesses to get a foothold or to get business in China. The key fact here I found, Nokia generated 5.9% of its total revenue from China. So I imagine that's been coming down for both of those companies, but it is still there. And so we'll watch for any weakness in that sector. And Bruno Cucinelli, if the weather has turned and has you thinking about warm knitwear, Guy, then keep an eye on Bruno Cucinelli. They have confirmed their growth goal, rejecting the claims made by a short seller. And so we keep an eye on that one at the start of trade.
I'm clinging to summer. I'm trying to cling to summer. I see Keir Starmer's just arrived in Copenhagen. We'll come back to that moment in just a moment. For now, though, we focus on what is happening with the European equity market open. Let's show you some numbers, give you an idea of what is going on. The FTSE 100 hitting a record yesterday, and it looks like we're going to continue to move higher on that market. We'll watch what happens with the grocery stocks today. We're also going to watch what happens with some of the defence names. Keep an eye on names like Rolls-Royce today, BAE Systems. Both could be interesting. Elsewhere, we'll wait and see what happens. We'll see what happens on the DAX today. There is an AI theme also running through these markets too, which is worth paying attention to. There's a lot of kind of different factors that you need to focus on. Clearly, obviously, what is happening in the bond market will have an influence on what we saw overnight in Japan, and what happens in the United States a little bit later on will be significant. But for the moment, looks like the European market is doing pretty well, and the CAC 40 in particular out of the gate strongly, up by 0.7%, Chrissy.
Absolutely. It feels like, the party just continues, and it is a tech theme, to your point, Guy, because I'm looking at the biggest index contributors. It's a lot what's in your core six, if you will. ASML, for example, Novo Nordisk, Schneider Electric, AstraZeneca, tech and healthcare seem to be the real drivers of today's session. But if you look at the screen right now, there isn't much that's in the red today. So, Anna, again, the party continues.
Yeah, absolutely. Only, 5 sectors in negative territory. Utilities is the worst performer. So does that give you a sort of broadly risk-on feel, at least at the margin? Autos and auto parts, the best performer. Stellantis, there was some news out of Stellantis, I think, wasn't there? Just yesterday. Yeah. Ferrari up by 3%, Stellantis up by over 4%. Valeo not doing too badly. So that's the movement at the upside. Technology also trading higher along with healthcare, so that one has turned around. But ASM International, up by more than 4% this morning, and ASML also up pretty strongly.
417 stocks up, 155 down. This is a market that's definitely on the front foot this morning. And as you say, it is the kind of the heavyweights that are driving that. The market does seem to be moving away from some of the more defensive names. Look at this. British American Tobacco is the biggest drag. Iberdrola, National Grid, Unilever. These are the kind of the more defensive end of the market. That is where we're not seeing maybe some of the strength coming through. Some of the energy names are a little bit weaker as well. But it is a continuation of yesterday's move in healthcare. Healthcare stocks are strong. You're seeing a move to the upside in the tech space, and that pharma story is there. We mentioned what's happening with the energy story. Siemens Energy also rising as well. This is a really positive mix of stocks here in terms of stocks that are moving on the upside. Luxury is also on the front foot as well.
Is that the Bruno Cucinelli story?
Well, it's been Bruno Cucinelli has been hit really hard of late as a result of some of the allegations that have been made. I'm not sure it's more to do with what's happening with the arrival of autumn and maybe more to do with the unwind of that story.
Bask in the glory of the green on the screen. Let's bring in some analysis here who can give us a better idea of what's going on. Remy Olu-Piton, head of multi-asset growth and income over at Schroders, joins us around the table. Pleasure to see you. Good morning. Does the party continue?
Well, the market's flushed with liquidity. And so, as a consequence, the path of least resistance is for markets to continue rising. So we have liquidity globally, both in the US, in Asia, and investors need to buy.
What gets in the way of that? We're in the fourth quarter. We're still expecting a lot of the geopolitical threats to surface. We are day 2 of a U.S. shutdown. There's fiscal debt worries on this side of Europe. The list goes on in terms of the worries. Does any of it matter going into year end?
I mean, the key thing is that we don't get a growth shock in the US. Now, ADP yesterday was a little bit concerning, but the markets decided to look through that. As we move into the fourth quarter, particularly the month of November, we will start to get more with regards to the labour market. And so right now, investors believe that it is just a softening. If we do get a big shock, a big negative print on payrolls, then that could derail this party that you mentioned.
And that's the difference between stocks going higher and lower, maybe, Remy, because if it's just a softening, the market assumes Fed cuts, that bad news becomes good news and stocks go higher. So what does it take for that story to become more definitively negative because it's a judgment on the state of the US economy and the jobs?
Exactly. I mean, right now, there is a view that the labour market data is mixed. It's unbelievable. But if we continue to see material weakness and really move into negative territory, then investors will pay attention. That means there's something more sinister happening.
Now, you upgraded recently US stocks, and that was partly to do with the Fed's reaction function. Is that because you're just assuming that the Fed will be more willing to backstop the market with rate cuts?
Absolutely.
That's not their primary motive.
Absolutely, good cuts, because one of the key things that the Fed mentioned is that monetary policy in the US is tight. And so if we do see a loosening in monetary policy with the data okay, and that is crucial, that the data is okay and the economy is resilient, this is a fantastic environment for buying stocks.
What should I be buying that others aren't at the moment? Like, if I want to diversify my portfolio, everybody's bought gold, everybody's bought US stocks, even the FTSE 100 hit a record yesterday. Where are you looking for the alpha, the outperformance that I can generate in this market? Or is this just a crowd-following story? FOMO, just everybody keep buying, it's liquidity-driven, we're disassociating ourselves with fundamentals. How do I differentiate myself, my portfolio, from what everybody else is doing at the moment?
I mean, from a multi-asset point of view and looking across asset at the top-down level, we think emerging markets is a very interesting area. Avoided for a long time. We have the dollar weakening, and we do believe it's a structural weakening right now. This is very positive for EM, particularly Asia. Now, markets in China, particularly Chinese tech companies, are very cheap relative to the US, and we think that actually there is a catch-up story there.
So I've been thinking about this trade, and does it all happen sort of neatly and nicely? Do people take money out of the US markets and just put it to work in emerging markets? Because that feels like that feels like nice and easy and neat and tidy. If the US market goes down, does it drag the rest of the world down?
It will drag the rest of the world down, but I think what's different to the past is the magnitude of the drag down. And so what we're arguing right now is that if the US goes down, unfortunately everywhere else will go down.
Right.
But the US now has a much larger beta because it will be driving that downside.
Okay.
The benefit of having you on the program for many reasons, but one of them is that you're looking multi-asset. We've got one eye firmly on a fixed income market that is kind of range-bound lately. I'm looking at 410 on the 10-year. What is the impact of 4% yield on a U.S. 10-year on stocks, and is it the same impact as 3.5%?
A 4% yield on the US 10-year is a relief for stocks, definitely, because we were discussing 5% at the start of this year. So that is a big relief. 3.5%, what would get us to 3.5%, in our opinion, would be a growth shock. So that might be a bad scenario. But 4% is a very comfortable scenario. However, what you are seeing is a lack of demand for those bonds, despite the fact that we're at 4%. Investors want more, and that's why gold is doing well.
Yeah, and you don't see us getting that severe a growth shock, so you don't see yields getting that low, I think, Remy, but you do like gold. So we just carry on with more of the same. Stocks higher, gold higher. Do those, from your multi-asset perspective, do those things fit together? The fact that we have gold at record highs and stocks at record highs?
They do fit together temporarily, but they are giving us a sign that something's not quite right. I think what we need to focus on is inflation, and that is why investors are not buying into bonds right now. There is a view that, for now, we have this benign environment. But what are we going to look at in 2026? If the Fed is cutting because the economy is okay, surely this means inflation is going to come back. So as investors, we need to start looking for real assets. And that's why you are seeing that demand for gold. Unfortunately, other commodities are not moving with it. We think that once we get that sign that inflation's coming back, perhaps other commodities will wake up. Perhaps energy may also join that party, but that's definitely something we need to think about.
You don't think gold's at an extreme level at the moment? You think it can go higher?
I'm struggling to evaluate, to give you a level for gold, but the momentum is strong and the trend is strong. And what is different this time round is that we are questioning the role of bonds. And so the only alternative for that is commodities like gold. So it can definitely go higher, in our opinion.
Okay.
Do you go to, ultimately, in terms of playing gold, do you just do the physical commodity? Do you do the ETF, GLD? Or is it looking at ways of either playing international bonds or sovereign bonds based on holdings from central banks? Is it mining stocks? Is there a second derivative play from the physical commodity?
I think the second derivative play is very interesting today, and that gives you a very, from a capital efficient point of view, for investors that can, the second derivative by owning gold equities provides significantly more upside. And one could argue that a lot of those companies are trading at a very attractive multiple relative to the price of gold. But not all investors are able to do that. So primary is the bullion, and silver is also interesting right now. Again, that's a little behind gold, so that that could also continue to do well. But for investors that can, gold, equities, mining stocks, absolutely.
And Remy, you're not too excited by European stocks right now. And I mean, some people are nervous about US valuations, diversifying a little bit into Europe, given what Germany is doing, all that spending taking place fiscally. But you're not all that convinced.
I think there are some areas in Europe that's still very interesting. For example, the banks. We believe that with the yield curve staying quite steep, the banks can continue to do well. But the vast majority of the European equity market is quite challenging. Right now, Europe is playing catch-up because for some reason European equities paused in terms of outperformance around the summer. So there was a summer lull in Europe. And so there is a catch-up play, particularly around the defence stocks. So there are some really interesting themes within Europe, banks, defence stocks. But broadly speaking, the entire European complex, I think that if we're comparing apples with apples, there are more interesting themes outside of Europe.
It's great to see you. Thanks for stopping by to see us. Covered a lot of ground this morning. Remy Pitan, Head of Multi-Asset Growth and Income over at Schroders. Core 6 looks a little like this morning. Let's take a look at some numbers and figure out what is happening. Just remember that there are some XDs in the market today. I misspoke about BAT. It's gone XD today. That is one of the reasons why it is softer. But elsewhere we see strength. We see strength in the pharmaceutical space. Look at what is happening with Novo this morning. LVMH is up quite strongly. The defence space is up. Tech is up. Even names like Nestle are tracking a little bit higher. I think we're off our highs, but there's plenty to focus on this morning for Chloe Melly.
Good morning, guys. Let's start with the chip sector this morning. And it's up across the board. We've got this wall of green for Infineon, SM, STMicro and ASML because of some positive news flow linked to AI investment, including Asian chip companies signing a supply agreement with OpenAI's Stargate project, as well as news of investment from Intel and Western Digital as well. So there seems to be this rising momentum, rising investment in that sector, and there's really driving the shares across that semiconductor industry in Europe this morning. Moving on to luxury, where Brunello Cucinelli is up, and that is because it reaffirmed its growth target. It also reported a jump in sales, and it denied allegations made by a short seller that it was still operating in Russia despite sanctions and despite the fact that it had said it was no longer operating there. So it seemed that investors are quite positive on all of this, on the denial of allegations, as well as the positive earnings this morning. Moving on to Germany, where Siemens is also up, and Siemens Health in it as well, on the back of reports that that Siemens is exploring a spin-off of its majority stake in Siemens Health and kind of refocusing on being an industrial tech company rather than this really diversified conglomerate that it is at the moment. So a little bit of positive movement on the back of that this morning. Moving on to Novo Nordisk, that was upgraded to a buy rating at HSBC. HSBC said that the company was now turning a corner and that its direct-to-consumer channel would really help with that, and that is driving the shares up 3% this morning. And finally, another movement for positive movement for Stellantis, which is also up 6.4% this morning after getting upgraded at banker Acros to a buy rating as well, after a little bit of weakness for the car maker.
Chloe, thank you. Chloe Melly from our equities team. We are monitoring what is happening over in Copenhagen. Of course, we saw European Union leaders meeting there yesterday. Today, the meeting widens to that wider cooperative group around Europe set up by the French president. And so we're watching to see, we saw Keir Starmer arriving just moments ago, other European leaders currently passing by the world's media and giving their thoughts on, no doubt, the state of European defence, which is the big topic of conversation over in Copenhagen.
Absolutely, and defence stocks are... So we've seen a really sort of mixed performance so far this week from defence stocks. In the run-up to this meeting, we saw actually some performance yesterday, actually some weakness today. We're bouncing back quite strongly. Names like Rheinmetall are doing really well. And the kind of the technology story that you have to follow to keep up to speed with what is happening here, the advancements in drone technology, in missile defence technology, really, it is fascinating to watch what is happening and how it feeds into the European defence space and the global defence space. There's concerns now that Patriot missiles are not hitting some of the ballistic missiles that are being fired at Ukraine at the moment. How does that feed back into some of the US defence names? So much is... the technology in the space is moving really quickly. The AI story in this as well is moving incredibly quickly.
So the technology moves really quickly. The politics moves pretty quickly, actually, for Europe. I mean, our guest coming up in just minutes, in fact, from Alphavalue, argues that we are at a tipping point. This summit, what is happening around around Copenhagen represents something of a tipping point for actually realising some of that defence investment by Europe.
Absolutely, and I think from a, to your point, political point of view over in the States, a sentiment shift as well in just the last 7 days from the White House in terms of just how tough they want to be on Russia and just how much support they're willing to give to Ukraine.
Yeah, certainly something we will watch as it evolves. Coming up on the programme, we check in on Volvo after its sales update and also look to the Chinese EVs, which are competing with European car makers for market share. Some really interesting stats out on hybrid sales in Europe. That's next. This is Bloomberg.
Welcome back. Watching the opening trade. We are 18 minutes into the session, and as you can see, Europe and its equities are on the front foot this morning. There's a lot of green out there. Tech is driving it. Pharmaceuticals continue to have a very strong performance. We are watching what is happening in the auto space as well. Shares in Volvo Car trading a little higher. It's reporting a 1% rise in September sales, but sales of fully electric cars fell by 3%, which is interesting because actually the market feels like it's kind of actually gaining a little bit of traction at the moment, and the hybrid story is really gaining quite a lot of traction too, and you're certainly seeing the car sales numbers there reflected with some of the Chinese deliveries looking really good. Let's pull it all together. There's a lot to talk about in the global auto space. I barely know where to begin, therefore, with Craig Trudell, our autos editor. Is there anything useful that comes out of the Volvo numbers this morning that tells us what the bigger picture is?
Yeah, those headline numbers you talked about, 1-3% change, doesn't look on the surface like a whole lot. But if you dig into the U.S., I actually think is probably the most interesting story for me. And it was consistent with what we heard from a lot of manufacturers yesterday, that a huge jump in fully electric vehicle sales, both for the month of September and the quarter as a whole, with American consumers rushing to take advantage of the $7,500 tax credit before it goes away. A 52% increase for Volvo, pretty substantial, and they've more than doubled fully electric vehicle sales in the U.S. That is off somewhat of a low base, and I would also expect to see those numbers really sort of flip. We're hearing a lot of manufacturers say they're going to try and sort of put off the pain by extending some deals to sort of, I guess, take on some of the burden from the federal government stepping back and no longer supporting that segment.
Let me ask you about the role of Chinese manufacturers right now then, Craig, because we've been watching them get a pretty small percentage share here in Europe, and obviously the politics has been playing out pretty quickly in terms of making that more difficult for them. But then looking at the hybrid market specifically, they're above, 9% in terms of the European hybrid market now. This is gaining momentum.
Yeah, and there was a lot of sort of theorizing that this was going to be a sort of bridge technology, right? And that it's turning out that bridge is going to be much longer than I think a lot of the manufacturers reckoned. Yeah. I think this is also a consequence of loopholes in the trade policy, where we saw Brussels say, the Chinese manufacturers are coming in here with battery electric vehicles that are substantially, sort of funded or supported by the government. They left open an opportunity for these manufacturers to come in with plug-in hybrids as opposed to battery electric vehicles, and those plug-in hybrids are not subject to the tariffs that were put in place last year. And so we've seen the battery electric vehicle sales actually hold up decently despite those tariffs. But the hybrids have not been subject to higher duties, and they've really taken off in the last year.
You see a lot of BYDs. I'm starting to see BYDs in London in a way
everywhere,
that I've never seen. Just almost in the last few weeks, they're starting to show up in quite a big way.
Got to pay attention to the cars in London. I just avoid them. Talk to us about Tesla.
It's going to be a pretty interesting set of numbers later today. I think the question will be with the U.S. support going away, just how lasting a potential increase that we could see for the quarter. I think the consensus that we still have is for a small decline, but a lot of sell-side analysts toward the very end of the month were coming out and sort of projecting actually a bit of an increase from a year ago. I think it's pretty sort of widely held that the expectation for the last quarter of the year being quite weak, and a sort of continuation of this trend of them having trouble with their sort of core business, even as they've talked about trying to bring a lower cost Model Y to market once these tax credits go away to kind of support their sales, particularly in the U.S., still their biggest market.
All right. Craig Trudell, Bloomberg's global autos editor, giving us a worldview of all things we need to know in the world of cars. We thank you so much. Let's go to another Bloomberg scoop. We've learned that ChatGPT maker OpenAI has completed a deal at a valuation of, get this, $500 billion. That's roughly around the market cap of Netflix, making it the world's most valuable startup. Bloomberg's Valerie Teitel is all over this story. Val, walk us through the details of the share sale.
Look, some positives for OpenAI in the details of this share sale. Not only, as you mentioned, they notched yet another record for their valuation, this time reaching $500 billion. But the take-up of the secondary sale was actually less than what OpenAI said that they were going to allow. They basically offered employees up to $10 billion of liquidity in their shares if they wanted it. Employees only took up $6.6 billion. So to me, this really shows that employees at OpenAI are really convinced in the long-term picture of the company. Now, remember, they offered this share sale as a way to keep and retain employees and maybe prevent them from talking to Meta and those 100 million plus deal offers that they were offering AI researchers. But I think this does show that at least employees at OpenAI are convinced in the long-term picture.
It was previously valued at $300 billion. When? Like just a couple of months ago?
End of March.
Yeah. So the rate is pretty extraordinary in terms of what we're seeing here.
Yeah, so that implies around, a sub 70% gain from the end of March until now. But if you compare that to how NVIDIA has actually done since then, NVIDIA has gained 80%. Right. So it is basically marking itself to market when it comes to this AI trade.
Money, Guy's still in search of the revenues.
Yes, but essentially it's not a bombastic valuation that they announced today in the share sale.
Yeah, even if it is still a private company. Now, Sam Altman is heading to Taiwan today. He was recently in South Korea, and South Korean stocks went up 3%, Valerie. So what do we conclude?
Well, look, the discussions today could potentially be more impactful for OpenAI's future. He is reported to be meeting with TSMC, the world's largest and most advanced chip design manufacturer, and with Foxconn, who is the world's largest contract manufacturer when it comes to electronics. A key discussion point which might be on the table is OpenAI's own chip design ambitions. We know this is something they've been thinking about. Perhaps it would pave a way for them to be less reliant on NVIDIA when it comes to AI accelerators. So these discussions...
Did NVIDIA just invest lots of money in this business?
Well, essentially, they need all the help they can get. I think that's what the deals with South Korea showed as well. But they're looking for other ways to maybe cut the reliance on NVIDIA. And today's discussions with TSMC and Foxconn might be paving the way for them to do that.
Valerie, thank you very much. Bloomberg's Valerie Teitel with the latest on technology. We are going to be heading to Copenhagen shortly. We're still seeing European leaders arriving for this expanded European leaders meeting. Yesterday it was the European Union. Today it's this wider group. He's not speaking now, but we just saw NATO's Mark Rutte at the podium, at the microphones with all of the assembled press. And we're going to have a conversation about defence and where the European story goes from here. There's been a lot of talk about a drone wall. I'm interested to get the analyst at Alphavalue's view on whether that really is a thing or if this is just sort of nice slogan to have, whether that really means anything.
But the real shift here, there's this... I'm starting to see articles being written about whether or not Europe just needs to recognise that it is at war. The whole of Europe is at war, and that is the narrative that we now need to be plugging in these kinds of meetings into, that Europe is now thinking about this on a completely different footing to where it was before, even just a few months ago. But also the fact that Trump, there's a story floating around as well, I think it was in the Journal earlier, talking about the fact that long-range missiles could now be used. That is a big step forward in terms of how this conflict could develop. If you're striking much further in, if you're going offensive into Russia from a Ukrainian point of view, in a more meaningful way, that's going to change the narrative.
And you put that question to Francisco Blanch earlier in terms of energy infrastructure as well. But from a political point of view, they've done a full 360 in terms of coming right back to where the Biden administration was on their stance on Ukraine.
Well, we'll see. Yeah, we'll see how that stance evolves and think about that in the weeks ahead. We'll head back to Copenhagen shortly. We will also get analysis on the defence sector. This is Bloomberg.
Welcome back to the opening trade. 30 minutes into today's session, green on the screen across the board. Some slight underperformance for the FTSE 100, unchanged there. We'll give it to them. They're barely in the green. We'll call it a win. The outperformer this morning, I thought was going to be the DAX, given the defense story, given the tech story. It's actually the CAC Huron higher by 0.8%, Guy.
Luxury's on the front foot this morning, farmers on the front foot, banks are on the front foot, all of that driving the cat odds. FTSE 100 hit a record yesterday. We'll give it a pass maybe today. Let's talk about what we're seeing in the market today. Definitely the balance is favouring the winners this morning. 403 up, 186 down, 2 to 1. You've got a really strong volume story that is backing all this up as well. Let's talk about some of the 52-week highs and what we're seeing there. Hochtief. Let's talk about what is going on there. A double upgrade at Bank of America being well received by the market. That stock is up by nearly 6% this morning. Kering, Gucci, just had its best quarter ever. Luca De Maio, the new boss over at that business, is starting to gain traction. Is it too early to tell whether or not that traction ultimately sticks? Well, at the moment, the market continues to like the story. Kering is up by 1.6%. The luxury story is on the front foot this morning. We are seeing gains across the piece when it comes to that. Just keep an eye on Valentino. ASML. We are obviously seeing gains in tech. We've been talking about the AI story this morning. ASML is up very nicely on the back of what we're seeing in the chip space, up by nearly 5%. So some really interesting 52-week highs today, Anna.
Yes, absolutely. Interesting 52-week highs and interesting news flow surrounding the United States. Let's talk about the shutdown. President Trump says he plans to use the shutdown to fire federal workers. This as the White House holds billions in funding for projects in Democratic states. Sources say House lawmakers have been told that some agencies will terminate workers within 1 or 2 days, although it's unclear which positions or agencies would be affected. The US Supreme Court has refused to allow President Trump to immediately fire Fed Governor Lisa Cook while she sues to keep her job. The decision deals a setback to President Trump's efforts to exert more control over the central bank. The order means that Cook can remain in her position until the justices rule. That will take place after the hearing of arguments, which is scheduled for January. And European Union leaders are building momentum for a plan to loan Ukraine 140 billion euros from immobilized Russian central bank assets. The proposal has gained backing from several EU nations and comes as European political community leaders meet in Copenhagen today. And Chrissy, that is where our coverage heads next.
Absolutely. For more on that European defense story, we're joined by our very own Oliver Cook, who, of course, is live on the scene. Ollie, what can we expect from the leaders' meeting?
Yeah, so listen, Critty, I won't go into all of the nitty-gritty about the sort of broad strokes of how the Europeans are looking to unlock that 140 billion euros of assets that are being held currently in Belgium. Just to say that basically this is an idea that has got a lot more momentum now, and it seems to be on this question where there is a will, there is a way, and there is a will chiefly from the Chancellor of Germany, Friedrich Merz, who came out last week basically in favor of trying to mobilize these assets, trying to monetize them through some sort of inventive financial engineering so that it's not actually stealing the assets, so there's not sort of a question about sort of private property, which would put into question the reserve status of the euro and a lot of. But it seems that they're able to find a way to work around it. And that was really one of the main points that they were talking about yesterday. That's going to be kicked down the road to the next 2 weeks in order to get a sort of finalized approach to this at a formal leaders meeting in a couple weeks' time. But then the other question is this roadmap. Defense readiness that the Europeans have been talking about for 2030. And this has to do with the European Commission's proposal on how to get the European continent as a whole ready to basically fight Russia if they have to in the next 5 years. And in order to do that, you need to have, yes, the spending, but there also needs to be concrete plans, concrete milestones that money is spent, and sort of collective projects, and really thinking conceptually about European defense, not as the defense of Poland, of Italy, of France, of Portugal, but really the European continent as a whole. And that is really where the European Commission would like to take the thinking, and taking the thinking into the concrete is the next step. And one of those things that sort of got a lot of attention is this idea of the drone wall. This is something that we've been talking a lot about over the last couple of years, but really has gained momentum over the last couple of days in meetings here. And what it actually means clear. So I spoke to the CEO of Kongsberg, the Norwegian defense giant, who actually would be participating in some of these things, about what exactly this drone wall is and how it would work. Have a listen to what he had to say.
The drone wall is a part of a bigger air shield defense. Kongsberg are into the air shield defense. We are having our air defense systems, which is a medium range today. We are expanding that, ambition to expand that to the long range. I guess it's also quite, recent what we have seen here in Denmark and in Copenhagen. Yeah. But it's for me, it's a part of the entire air defense system. Mm-hmm.
So it's one thing hearing from all of these leaders and hearing all the rhetoric around it and actually speaking to the CEOs who are going to be really responsible for developing these systems and getting the orders. There's a little bit more skepticism and a little bit of concern that basically they don't have all of the order certainty that they require, and that the Europeans are not working yet totally in unison, because this is an air system that, yes, will be going across several countries. They need to be interoperable. They need to be able to function with one another. And, of course, joint procurement is one of the ways to unlock all the benefits of the scale that you get for the Europeans. We're not quite there yet, but that is the roadmap for 2030 that the Commission has just put out, and that is where the work for the European leaders is going to continue over the next couple of weeks.
Oliver, thanks very much. Bloomberg's Oliver Crook in Copenhagen. Let's stick with the defence theme. We're joined by Simon Hussain, equity analyst at Alphavalue. Simon, nice to have you with us. Thank you so much for giving us your time. I want to start by asking how much of a tipping point this is. These meetings in Copenhagen, this push towards actually turning some spending commitments into reality. That's how you describe this, as a tipping point. Why so? Why does this take on such significance?
I mean, first of all, thank you so much for having me today. So I feel like Copenhagen is really a continuation of what we have seen over the past couple of years. We really see that Europe has waken up to the reality that defense is no longer optional. And the political tone here in Copenhagen is really urgency. So the matter is really about Europe defense cooperation, support to Ukraine, as well as accelerating capabilities and deliveries.
OK, so things got more real. You also reference, Simon, that Europe needs to become a combat-ready defense economy. How far away is Europe from being that now?
So right now, European defense contractors are still lagging behind in terms of defense. We are not yet there. So this is the reason why European budgets is increasing a lot. So we were talking about 251 billion euros back in 2021. Now we are at 343 billion euros, and we will move from 2% to 5% of GDP spending. So this could mean 1 trillion euros in spending for defense. With 300 billion euros that will go directly into procurement. And I think it is crucial for companies to have this budget in order to ramp up and scale up quickly to meet the demand.
Good morning, it's Guy. There was a story yesterday suggesting that the German government, led by Friedrich Merz, wants to maintain control of how this spend happens, rather than letting it happen centrally at a Brussels level. Who do you think is going to end up determining how Europe spends money, where it gets spent? Who is going to control the purse strings when it comes to deciding what happens here?
So I believe there is more and more cooperation at the European level, for sure, with the EU Council, the EDA, and every organization that are trying really to help organize and cooperate in terms of procurement programs. But at the end of the day, it's really the national governments that and the treasuries that are signing the budgets, with defense ministries setting the requirements. So, I mean, of course, there are some guidance at the EU level, at the NATO level as well. But at the end of the day, it's really national governments who decide.
Simon, it's Kriti in London. Is there a question of valuations when it comes to defense? It feels like defense in Europe is akin to technology mega cap stocks in the States. How much investment can that really attract at these levels?
I mean, if you're looking at defense stocks, European defense stock valuation have re-rated a lot. So we've been, in Alphavalue coverage, we went from 11 times pre-war PE to more than 36 times now. But I feel like defense stocks are now considered more as growth stocks, as you mentioned, than classical industrial stock. And a metric which is more appropriate for growth stock would be PEG ratio, which is basically the PE divided by the forward-looking growth. And a lot of companies are still well below 2, which means that there is still a lot of room for upside going forward as contracts materialize.
Simon, when we talk about that growth trajectory, though, defense companies, at least if you go by the roadmap you see in the States, so much of that revenue is tied to federal contracts. When you look at the government contracts being awarded, or at least even promised, but then also balancing that with some of the fiscal debt issues and the balance sheet issues, does that undermine the case for a sure thing that is defense?
I mean, of course, there's the risk that we don't have the actual budget. It's really an issue. But the thing is, the Ukraine war has really led to a paradigm shift for European countries. So they really need to focus on defense. So I believe that there will be inflow for defense companies. The budget will be there. I mean, it's a matter of time. Of course, execution will be key. The scalability, the ramp up, how much time it will take is really key. But I think the budget will be there, as Russia is seen as a threat for European country, and it really shows the urgency of the matter.
Can I just draw a parallel as well back to the technology story? When I talk to defence experts in Europe, they talk about the fact that there is a capability need, that we need to develop hardware, that we need to make sure that Europe has the capability to be able to defend itself. But they also talk about the gap that exists currently in AI and the technology that goes with that. And I'm just wondering where Europe sits in terms of its ability to develop that software, the technology that is going to be needed, that is so evidenced on a daily basis in terms of the conflict that Ukraine is fighting right now. How strong is Europe? Do we have the startups? Do we have the technology necessary to deliver not only the hardware we need, but the software we need in Europe?
I mean, it's a very good question. Actually, I feel like a lot of companies are still lagging behind. We're not at the level of American for sure. But there has been a lot of investment on research and development by many companies. We can mention Thales, which is developing AI-related software. We can mention BAE, as well as Leonardo. So they are all trying to have this AI-related software. So, I mean, cybersecurity, electronic warfare, and AI is really becoming important in today's warfare. And I feel like it's also interesting to include Ukrainian companies that have this know-how, as well as the battlefield knowledge, so that European company can really start to catch up with American peers.
All right, Saima Hussein, equity analyst over at Alphavalue, walking us through some of the dynamics in the defense space. We thank you so much. I want to switch to the UK, where it's being reported that the government is weighing a plan to exempt shares of newly listed companies from a tax on trading. According to the Financial Times, Chancellor Rachel Reeves could announce up to 3 years of relief from stamp duties for newly listed companies, all coming in her budget next month. The tax, of course, seen as a key drag on the City of London. Meanwhile, the chief executive of the London Stock Exchange says the flagship market is, quote, not for sale, even though it could have a willing buyer in rival Euronext. A conversation we had right here on this show. Julia Hoggett also made the case for investing in the UK. Take a listen.
You asked about mandation. For me, it's much more about saying if you want to be designated as a default pension scheme in the UK, then you should have a globally diversified portfolio, but not necessarily index weighted, which is not diversified because that basically means 70% of your money is in the US with a declining dollar right now. And actually, say 20-25% should be invested in UK assets of whatever description you have. Now, you can then opt out as a pensioner, get your full tax credit in the non-default scheme. But if you want to be in the default scheme, and the interesting thing is we've run scenarios on this, we've actually done a survey on this, or New Financial did. The average pensioner that was surveyed thought that 41% of their pension funds' equities were invested in the UK. It's about 4. Okay? 72% wanted the government to support their pension money going to invest in the companies that were the future that their kids would be employed by, simply put. And
so again, it's the story.
It's perceived as a political risk, but perversely, we have made choices in the last 25 years to actually create incentives to subsidize the cost of capital of the S&P 500, not the cost of capital of the FTSE 350. And most countries in the world look at us sideways. So I genuinely think that the thing that I'd love to see is the confidence to make that choice, to say, yes, we want Britain to be investing in itself again. And I'll say one thing, I have heard the argument, but there's nothing to buy here. Now, you just mentioned Revolut, okay? I see a remarkable number of entrepreneurs up and down this country doing remarkable, groundbreaking things every single day, you know? And I think if you look at it, the major pension funds in Canada, in Australia, the major endowments in the US, the sovereign wealth funds, where do they set up their first office to buy assets overseas? London.
Well, look, you've talked about remarkable fintechs, including your own, and overseas interest. We had the Euronext boss on Bloomberg TV saying that he might be interested in buying the LSE. It's easy to say it on Bloomberg TV. Have you actually had a knock on your door with an offer?
It's not for sale. No, look, I'll be very clear with you. It matters to me that I run the only primary exchange in the London Stock Exchange Group. That means I'm not in the slightest bit conflicted to be the biggest possible advocate for the health of the UK equity capital markets. And I operate in a group that has a market cap bigger than Euronext does. And I've seen what's happened to other exchanges in the group, because it's quite difficult to prioritise one when you own several.
London Stock Exchange CEO Julia Hoggett there speaking to Lizzie Burden. Coming up on the programme, we'll bring you the latest on the US government shutdown, with concerns over delayed data and potential firings looming over markets. Where does this story go next? This is Bloomberg.
Welcome back to the opening trade. About 50 minutes into today's session, green on the screen across the board, except for right here in the UK. That was a flip dynamic yesterday. We saw the UK be the outperformer, down only 0.1% this morning. We'll see if in the rest of the trade if it all shakes out. In the meantime, we're, of course, digesting what is going on the other side of the Atlantic. Bloomberg has learned that the White House budget director is planning to swiftly dismiss federal workers within 1 to 2 days. Those comments coming from the press secretary, Caroline Leavitt. Joining me now, Bloomberg News desk editor Jill Deasy's. Jill, just walk us through the shutdown story. Is this a very quick, by the end of the week, the government is back up and running, or is this here to stay for a bit?
Yeah, I mean, Kriti, I think that's an open question at this point. So now Vice President J.D. Vance says he thinks the shutdown is going to be over quickly, but I think that depends on whether either side can kind of resolve some of these issues that they're looking at. So on the Republican side, they're obviously, they're starting to use sort of this pressure of either laying off federal workers or even targeting actually funding for programs, particularly in blue states, as maybe some levers that they can pull as they try to bring this to a close. They're trying to get more Democrats to vote with them. Ultimately, the Republicans really only need 8 Democrats from the Senate to actually come over so that they can pass that stopgap spending bill. During the last vote on Tuesday, I think they got 3, so they're really looking for maybe about 5 more. So that's where it looks like on the Republican side, maybe that's possible. But at the same time, you also have Democrats who are kind of digging in their heels and saying, look, we really want to address at least some of the concerns that they've brought. Key among those issues is health care. So I think that the main issue they're looking at is the idea of extending subsidies that would be expiring under Affordable Care Act premiums. So the idea that people's premiums may be going up. If these subsidies aren't extended, that's one sort of wedge issue for the Democrats. I think ultimately ending the shutdown anytime soon kind of comes to whether they can actually reach some kind of an agreement, or again, ultimately, if those Republicans can pull more Democrats over to their point of view.
Let's talk about the pressure that the White House is putting on the Democrats to get this done. We're talking about hydrogen. We're talking about all kinds of things that are being used by this administration to put pressure on the Democrats. Just walk us through how big this is.
Yes, that's right. So it looks like what the administration is trying to do is ultimately target federal funding for certain programs. So now there's one looking at New York State. There's a couple of infrastructure projects in around New York City that have been, sort of pulled funding for. Ultimately, what we've heard from the administration is that this is due to what they've called DEI, so diversity, equity, and inclusion initiatives. But, the timing around the shutdown and the fact that it would directly affect, constituents of, some people like Democratic Senator Chuck Schumer, I think kind of raises that question of whether that's really, again, one of those pressure points. And then the other thing that we're looking at is this idea of pulling federal funding for projects, renewable energy projects in states that voted for Kamala Harris in the last presidential election. So those are some of the pressure points that the White House seems to be using here. Again, I think whether that actually works, open question, but we'll see what happens and if ultimately they can kind of reach some kind of an agreement. But I do want to point out that what we're talking about here is really just a stopgap spending bill. I think all of this kind of debate ultimately could come up again in just a matter of weeks, if not, by mid-November again.
All right, Bloomberg News desk editor Jill Deasy's walking us through the dynamics of Washington. I feel like the message is hold your horses, basically. We thank you so much. Plenty of day book data to keep an eye on. 10 a.m. Euro area unemployment is going to be hitting the Bloomberg terminal, but the read-through from the shutdown could likely mean delayed U.S. data, as Jill was just mentioning. Jobless data, factory orders as well, all on the docket. Again, we'll see how spotty that actually comes. Some commentary, though, expected from the Federal Reserve. Lori Logan due to speak at about 3:30 p.m. UK time. And then at 5:30 p.m. UK time, some ECB speak as well. Villeroy and de Guindos due to hit the wire.
Yes. Interesting that the Fed doesn't shut down during a shutdown.
Essential services.
Right. Yes. Let's bring in Valerie Teitel for more. Valerie, so it's likely we don't get the jobs data, but we had ADP yesterday. Looking at that now, a few hours on, does it seem like we overreacted? I mean, the market read a lot into that because it probably thought it won't get any more.
No, it definitely did. Definitely did read a lot into it, given we had the biggest move in the front end that we've seen in around 4 weeks' time since the previous non-farm payrolls report. But I think it was just more evidence that the labor market is on a weakening trend. And honestly, it seemed like that was enough for the market to really be confident of an October Fed cut, regardless if we get any more data.
The market really wants a rate cut. And basically it's hanging its hat on anything, but how many and how far do they go? And without the data, how convinced can we be that we can extrapolate? Maybe we get one more. But without any data at the moment, it gets really foggy beyond that kind of next rate cut.
Well, it's hard to see the Fed at least becoming incrementally more dovish in their language at the end of October without any more incremental data for them to rely on. But when I say that, the market is really keen to price this in. We saw it yesterday with the reaction to ADP. But remember, we still get some sorts of data coming out. I know we don't get the big ones. We don't get NFP or CPI, or likely not CPI unless it reopens.
Like a long way away,
it does, yes. Yeah. But we'll still get things like we got yesterday ISM manufacturing, we have ISM services on Friday. So we still get some sort of hints for how the month has been developing.
I mean, negative ADP, we just don't get it very often. Just looking back, a few months ago we did, and a couple of years ago we did, but these are just, 1 month here and there.
And now we've had 2 consecutive months. If you take the revisions into account, the ADP is now contracted for 2 months running. And there was decent breadth of weakness in yesterday's report. 70% of industries reported declining hiring in yesterday's print.
But bad news is good news.
For the equity market, it is at the moment.
Valerie, at the moment. Keywords. Valerie Teitel. Tomorrow we're going to bring you a conversation with the Chief Executive Officer of Goldman Sachs. Tom McKenzie is going to be speaking to David Solomon about the impact that AI is having on infrastructure in the financial services sector. It's a conversation you're not going to want to miss. This is Bloomberg.